At the end of the day, what we want to do is we want to reduce your risk for you through insurance and through other areas of risk management that you can put in place. If there's one thing that I would love for you to take away from this presentation today is a word called coinsurance. And we're going to get into that right now. And coinsurance is you'll find it on almost all insurance policies. A coinsurance clause says we will give you full replacement cost coverage in the event of a partial loss as long as the limit on your policy is within at least 90% of what it would cost to rebuild at today's prices. So for this reason, the first time that you contact your insurance broker when you purchase a property, that first 5 minutes of giving them the details on the property, I think, is the most important way for you guys to protect yourselves and for your broker to do a proper job for you. So what we find sometimes is we'll have individuals that'll purchase properties and they'll say, yeah, I got a great deal on this property. It's $125,000. Please add it to my policy. Take possession November 1st. Well, what the broker needs to do is the broker needs to ask the question, how did we come up with that $125,000? Was it the purchase price? Are we using tax assessment value? Or are we actually doing a rebuilding cost evaluation on this property? And here's a problem that you can run into. So let's say that you do phone up and you say, no, Ken, I got the property for $125,000. We're going to insure it on that basis. We get some details from you on the property. It turns out to rebuild it at today's prices is going to run you $250,000. So what ends up happening is 3 months in, we have a pipe burst. We have a $50,000 water damage claim in our dwelling. You phone me up. The adjuster comes out. He reviews the policy, or she reviews the policy, says, geez, I don't know, I think 125 is on the light side here. So they do a coinsurance calculation. And when they do this, you find out how much would the insurer pay and how much are you going to have to pay now. You can flip it, please. So they say insurance carried divided by insurance required times the amount of the loss equals your payment. We keep it a little bit more in layman's terms. We say what did you insure to, what should you have insured to, times the loss equals your payout. So in this case, what did you insure to? $125,000. What should you have been at? Well, we told you in order to get replacement cost, you had to be at least at 90% of $250,000, which is $225,000. You multiply that by $50,000 loss. The insurance company is giving you a check for just under $28,000, and you're stuck holding the bag for $22,000. When this coinsurance clause occurs and a penalty is assessed, nobody wins. You're not happy, the broker's not happy because he knows you're not happy, and the insurance company's not happy either. So at the end of the day, we want to make sure as much as possible we're having good communication with our broker so that they can ensure or set the limit of coverage at the proper limit so that you don't have an issue like this. And again, just to emphasize, this is any type of partial loss. Smoke, water, vandalism, anything to that effect. So if there's one thing you really want to be cognizant about when you review your insurance each year with your broker is making sure your limits of coverage are where they need to be. Along the property lines, and again, just kind of the paragraph at the bottom there, just reiterating, if you hear someone upset about a claim, I guarantee you probably 80% of the time it's because they got hit with a coinsurance penalty and they were never aware or made aware that that was on their policy. Some other risk factors when it comes to your property policy we can talk about. You have two different options for insuring, replacement cost or actual cash value. Obviously, we recommend replacement cost. That way, if something goes wrong, you're getting the full bill. So if you go to an actual cash value limitation, that in essence is replacement cost minus depreciation. So one of the disadvantages of actual cash value is if you have a pipe burst, the adjuster will come out and say, your flooring's 15 years old, so we're going to depreciate that settlement by 30%. Your cabinets are new, we're only going to depreciate that by 5%. Your drywall, 20 years old, so we're going to depreciate that by 40%. So on an actual cash value claim, you could have a $10,000 claim, but all of a sudden now, once they depreciate it, again, you're only getting a check for $6,000. So as much as possible, we do recommend, again, if the property warrants it, if it's well looked after, if it's got the proper upgrades, to always have replacement cost coverage. One of the other options you can have with an insurance policy is there's two type of wordings. So we've talked about valuation, valuation meaning what you're going to get if there's a loss. Wording meaning what am I covered for? So the more basic form is something called fire and extended coverage, which in essence is fire, smoke, and your weather-related perils. Things like hail, lightning, wind, things of that nature. The more broader form of coverage is called all risk. It's a little bit of a misnomer because it's not all risk, not everything is covered. But it is a broader form of coverage, and again, the two big perils that it picks up that a fire and EC policy does not is water damage and vandalism coverage. Probably 60 to 70% of the claims that we have when it comes to rental properties are water damage. So if you have a fire and extended coverage policy, the only type of water damage you would be covered for would be if a sprinkler system bursts. But if it's just plumbing in a sink, toilet, anything like that, you need to have an all-risk policy to be covered for that. We brought this comment up earlier. Sometimes under insurance policies, they will have an exclusion for vandalism by tenants. And we had conversation earlier today. And again, it's something that if all of a sudden you start putting multiple claims in for this, chances are the insurance company will put that exclusion on the policy. But as much as possible, if you can, you'd like to have that removed from an insurance policy. So again, if you have a tenant that's maybe on some sort of substance and has had a bad day and wrecks a suite, that you have something to fall back on there. Other areas that you can look at in your policy, sewer backup coverage. Again, we've had situations in the city where the city is doing a good job trying to upgrade the sewer system. We have a lot of mature trees, though, in the city. They get into the sewer systems. They cause problems. Sewer backup coverage is an additional coverage you have to ask for. That will cover you if you have water or sewage come up through your sewer system, shower, toilet, and damage a gas furnace, hot water tank. Even the bigger flooring. The bigger issue, though, is if you happen to be away for a day or two and there's a sewer backup in the basement, now we start running into mold issues. And you know, anytime you have dirty water coming up, it's very expensive to get restoration crews in to clean that up. So without that coverage, you're on the hook for it. So again, if at all possible, it's nice to have sewer backup coverage as part of your policy. Contents coverage, most of you when renting out houses will have some white goods, fridge, stove, washer, dryer. Again, that's a separate coverage. You don't have to insure it, but it is not covered automatically under your building. I also wrote a couple other notes down. The gentleman from Garamuk brought a great point, bylaws coverage. If you have an older building and you know that your fire alarm system is going to need to be upgraded if there's ever a loss, we can insure that under your policy under contingent bylaws coverage. We had a situation recently where it was a shelter for teen runaways, and one of the tenants had lit the kitchen on fire. Thankfully, nobody was hurt, but when we came in to do the rebuilding cost, it was $25,000 more for increased fire alarm system in there. Have to have bylaws coverage to cover you for that. Rental value. Again, if there's a loss at one of your properties and you can't rent out the house for 3 or 4 months, you can purchase rental income insurance, which guarantees the money that you would have received had the loss not occurred. So again, you're still going to have to pay taxes, you're still going to have to pay utilities when they're doing their work, you're going to have to pay your mortgage. The rental income is there to protect your investment. And the other big thing just to talk about from a property standpoint, always really important to let your broker know if the property ever becomes vacant. There is an exclusion under an insurance policy if a dwelling is vacant for more than 30 days. You have a notification to let your broker know if a residence does become vacant, so please let them know that. We can still get you coverage for it. It's a little bit more expensive and a little bit more restricted, unfortunately, but if a building's sitting vacant for 2 or 3 months and your broker's not aware, they can deny the claim for that. So.
If you have a duplex and one suite is empty,
You're fine. Yeah. No, you're fine. Yeah, no problem there. And you know, again, if it's one of the things where a tenant's moving out and it's only a couple of days, you know, not a huge issue, right? But if all of a sudden, yeah, we know someone's moving out and we don't have anybody lined up, best to let them know that. So that is your, under the property, those are sort of your main exposures that you want to look at. The other big part of your policy is premises liability. So premises liability is, as a landlord, your due diligence to make sure that the dwelling and the area, your area surrounding the dwelling are safe. Couple ways to do that is make sure we have a clear understanding with the tenant on the housekeeping outside in the yard and in the house where the responsibility lies. I think you brought up a great point there about your tenant being responsible for snow removal. If there is an area that's more key than anything else that we will see more liability claims is absolutely slip and fall scenarios. So again, really important to, with respect to slip and falls, to make sure that there is a good understanding who's responsible for it. For those of you that maybe have multiple properties and you are contracting that out, great to have the contract as to how much snow takes place before the snow company comes out, so we know exactly if they're delayed that maybe that liability should fall back to them. So very important to have that. Ways that you can help reduce your exposure, you can have a log of when you did the snow removal or when you called the contracting company to do that. Certificates of insurance, another way for you guys to help transfer your risk. If you are paying someone to come in, re-roof your house, work on your furnace, plumbing, anything of that nature, it's important to ask that contractor to furbish you with a certificate of liability insurance. And here's how it benefits you. If I have a plumber come in and they do something negligent in their work, and 3 weeks later a pipe bursts on the second floor and I've got a $75,000 water damage claim, if I have a fire and EC policy, I'm not even covered for that, first off. If I have an all-risk policy, now I have a $75,000 loss on my insurance policy. But if that negligence has been due to the plumber, then we can now subrogate for those damages against the plumber. Or even more so, for those of you that have multiple properties, you can be listed as what's called an additional insured on that policy. And what happens then is if the plumber is negligent and you are an additional insured, the plumber's insurance policy will actually defend you and cover your costs. So it is a great way to transfer your risk, is to ask for certificates from your contractors, and again, it makes sure that they've got proper coverage in place, and that helps keep your loss ratio down. If you keep your loss ratio down, your premiums go down with that. So, another great way to help keep your premiums in check, and again, I certainly understand that maybe not all of your tenants can afford tenants insurance, but for those of you that think your tenants can, it's a great principle to put in place to say that your tenants do have to carry their own tenants insurance policy. You know, how many times have we picked up the paper and saw that, you know, there was a loss in a suite and the family in there had no coverage? You know, they're hoping the local community will donate some items to them. Tenants insurance covers your renter's own personal property on a replacement cost basis. So if something happens to their clothing, TVs, computers, they're going to be covered for that. It also provides them additional living expenses. So if they need to be put up in a hotel for a while the pipes burst in your home and it's being fixed, it will cover that. But also, a nice added protection for you folks is under your tenant's insurance, there is liability insurance. So again, if there's been negligence, our insurance policy will cover it, but now we can subrogate for some of those damages against the tenant's renter's policy. So we can actually, if we go to the next slide. So let's look at the example that one of your renters is cooking in the kitchen. They leave the pot on, causes a fire in the kitchen. So it has been due to negligence. Here's how the claim would play out. So the tenant's policy pays for damages, again, replacement costs. So if it was any of their own clothing, anything in the kitchen that got destroyed, their tenant's policy will cover that. And they will also, the property owner's policy will pay the difference for replacement cost on property insured versus the tenant's policy. So what would happen is we have a fire, there's $60,000 worth of damage to the kitchen. Our insurance company is going to cover that. They're going to go back and subrogate for those damages against the tenant. Now, in tort law in Canada, you can only sue for the actual cash value and damages. So maybe they can sue your tenant for $40,000. And if they do, now we only have a $20,000 loss on our insurance policy instead of a $60,000 loss. So again, the lower your loss ratio, the more competitive premium you can get. So this is just another way of providing a layer of protection for yourself to help keep your rates down. Plus, you know, allowing your tenants to have the ability to, you know, to have coverage for their own contents. And just to give you an idea, if it's sort of a basic tenants insurance policy, it would probably run your renters about $15 a month for insurance, just to give you an idea. If they have higher amounts, you know, it could be 20, 25, 30, but usually $15 a month's a good average just to throw out. And there are some property management firms out there I know that will not rent out suites unless their tenants do have tenants insurance in place and they receive proof of that. So.
You sounding well, but when somebody's in welfare, and you, especially, I have properties in the north end.
Sure. Oops.
To get the social service allowances, okay, the social service would laugh at you if you try to get any money from them because they say, this is the money they
Sure.
need.
Yeah, and absolutely, you know, and that's where I said you can't force this on everybody because some people, plain and simple, can't afford it, for sure. And again, you can't get blood from a stone either, right? At the end of the day, is the insurance company going to go and try and subrogate against someone they know that has no money? They won't. But if the situation happens where we know someone has the funds and they know that they have, you know, that they can afford tenants insurance and they should be carrying it, it's just an avenue for us to help keep our rates down. That's all. But no, I'm very sympathetic to knowing that, in a lot of properties, people, they're just hoping to put food on their plate, let alone worrying about.
Me too, I'm trying to put
Yeah. So that is sort of the bulk of really, a rental property. I mean, it all comes down to your property exposure, your liability, and having rental income. I just think it's really important in your communication with your broker to let them know as much as you can about your properties, and make sure that the broker's pushing you back. Insurance brokers are professionals. We shouldn't just be mailing policies out. We shouldn't be just accepting the status quo. It's important to prod you and ask you, have you done any changes? Oh yes, Ken, we've added on a 500 square foot addition to our building the last year. Okay, well then we need to change that, that rebuilding cost on our policy. And when you have a claim, again, our broker's job is to be your advocate, right? I would love if all claims went smooth. If they did, it would sure make life a lot easier, but they don't. Sometimes you get a bad contractor, sometimes you get a bad adjuster, sometimes there's a gray area in coverage, and your broker's there to be your advocate. So it's important to make sure you have that good communication with your broker. If you do, for sure it's going to help lower your total cost of risk at the end of the day, and hopefully provide better protection for your tenants and yourself at the same time. So,
Mortgage insurance,
yes.
what is that all about? It's a phrase I've recently heard.
Yeah, I'm not an expert on that. That falls more into the life and group side of things, but I know that there's, insurance that you can get where if all of a sudden you're unwell and you can't look after your properties, like almost a disability kicks in that will help pay for the mortgage.
It wasn't put to me that.
Okay.
That would cover the cost of the mortgage and the outstanding balance of the mortgage to the bank.
Okay. It could be.
Mortgage insurance.
Yeah, unfortunately, yeah. No. I'm bricks and mortar guy. And trip and fall, unfortunately, so.
Well, that's good.
Yeah.
I prepared buildings.
Yeah. Hi there.
What's your opinion of combining principal residence insurance with rental properties?
That's a great question. I think if you only have one or two rentals, I think it's beneficial. I think, again, if you have a good principal residence that's hasn't had a lot of claims, that you've got more premium. Like the more premium you can put on one policy to offset your losses, the better loss ratio you're going to have, right? And typically you can get a better rate on a rental property when it is part of your home insurance. But there comes a point where most personal lines markets are fine if you have 2 or 3 rental properties on the same policy or home insurance. But all of a sudden it's more like 5 or 6 or 8 or something like that. Then usually they say, hey, this is a bit more of a commercial risk. We think we need to have a commercial policy on this. So, yeah. The flip side to that would be if the rentals aren't in great areas or have had high risk claims, and you may not want that affecting your home insurance side. So it's, if they're well-run properties, I think you're better off to have it on the same policy as your home insurance. Yeah.
I have a question.
Sure.
I have a building that would cost $685,000 to rebuild.
Mm-hmm.
The premium in that building is probably, I've had quotes anywhere from $35,000 to $55,000 a year.
Okay.
The revenues that building brings in are $20,000 a year. That's before taxes.
Sure.
And then we have a $5,000 premium on insurance.
Mm-hmm.
Now, that leaves nothing.
Sure. I mean, yeah. I mean, you don't want to be insurance poor at the same time, right?
Yeah.
So.
This is the problem now.
Yep.
As we went through that earlier one, if you're underinsured, okay. Now, if I could pay for a $680,000 rebuild,
For sure.
where is there?
Yeah.
Is there somewhere I can go to avoid this exorbitant? I mean, I could self-insure
Mm-hmm.
for $5,000.
Well, there's a couple options. Sometimes what people do is they'll say, listen, they have enough properties. They'll say, yeah, it's all great and fine that I want replacement cost coverage, but in order to keep my premiums down, some people do. They'll insure on an actual cash value basis. They'll say if the replacement cost is $685,000, I'd love to have that coverage, but maybe the home doesn't qualify. Maybe the plumbing's older or the wiring's not all up to speed. Or they just decide I have so many properties I'm willing to take a little bit of a hit on a loss. Then maybe they insured on an actual cash value basis for $400,000. I just find it any.
They would come back at that point and say, well, you're pulling.
Yeah, but then it's based.
70% under.
No, but the coinsurance is then based on the actual cash value basis, not the replacement cost basis, right? So if you have a home that's $680,000 to rebuild, but let's say it's a 50-year-old home and maybe you depreciate, maybe the true actual cash value of that home is $400,000. then as long as you're within 90% of that 400,000, which would be 360, then you're going to be fine. But just keep in mind any claim that you have, though, there's going to be a partial settlement on it because they're going to depreciate part of that claim out. So, yeah.
Going back to this other part where insurance needs to protect the mortgage, I don't mean CMHC, I mean the owner of the
Yep.
building that has outstanding mortgages on properties.
Mm-hmm.
Is there any mortgage or any insurance policy that works in that direction?
Sorry, just to cover the mortgage itself?
Yeah.
You might find an insurance company that will do what's called an agreed value policy, but it's very rare that someone will do that, where they'll say, you know, we'll agree to insure to this limit. And the reason being, it's a simple calculation. If you have a total loss, right? Here's your check, you're all good. But what happens if you have a partial loss? You run right back to that same problem of how do we come up with a calculation of making sure that the insurance companies getting the proper premium for the proper exposure. And that's why they have that 90% coinsurance clause, is they say, they know the chances of a total loss occurring are pretty much slim to none. But they're saying, look, if you have a 3,000 square foot home, we have a far bigger exposure than if you have an 800 square foot home. So we have to make sure that that limit on the policy, you know, reflects that. So the other option too is sometimes with insurance companies, if you're a handyman or a very good contractor, with some insurance companies, you can get a decent credit by going to a higher deductible. So for some insurance companies, they don't give much of a credit, but you know, there's other companies that, you know, if you go from 1,000 to a 5,000 deductible, they might give you a 10 or 15% credit on your rates, whereas another insurance company might give you $100. So, you know, I would just make sure. I mean, you know, there's a lot of brokers in Winnipeg, and if you know, if that rate seems high, that, you know, maybe you look at other options out there just to see. So.
Well, last time I switched brokers, I paid $3,000 a year for the same coverage. So.
Mm-hmm. Yeah, and part of that is not all brokers deal with the same insurance companies, right? I mean, larger brokers will have more access to companies, smaller ones won't. But yeah, that's why it's, you know, and your broker should be doing that for you also. Each year at renewal, they should be saying, hey, look, here's the options we're looking at. I mean, it's not like you want to switch it every year, but they should be saying, you know, there's another market that's.
Before it was State Fair himself, I wasn't much concerned about my well-being.
Well, and that's why I say it's a relationship, right? A relationship goes both ways, not one. So.
Yes,
Yeah.
I found myself having a new husband.
Yeah.
An insurance broker.
Yes.
Are there areas in the city that Ranger Insurance won't cover?
Not that I'm aware of. Now, you have to remember, we're a broker, so we deal with a number of different underwriting companies, right? If you had asked me that question in 2001, after September 11th, yeah, there was a couple areas in the city that most insurance companies would not offer coverage on. I'll try and wrap this up quick because I know we're going late, but that is more so when companies decide not to write in certain areas, that's more an indication of the insurance industry as a whole. So we call our industry goes through what we call soft markets and hard markets. In a soft market, the insurance companies are doing well, and in that case, they make all their money off the investment market, right? So in that case, they're saying, yeah, we'll write here, and we'll drop our rates, and we'll offer extra coverage because they want to get as much business as they can in to go and invest it. Conversely, when the investment market drops, which is exactly what happened after September 11th, now all of a sudden their profit margin shut down. Well, what's the easiest way to raise our profit margin? Let's raise our rates. So all of a sudden they start raising rates, and they start pulling out of certain areas or classes of certain areas of the city or certain classes of business because they're not making as much money in it. So no, certainly you can always find insurance. It's just, and in this market, this is a good market right now for the consumer. When the market hardens, yeah, sometimes there's only a couple of markets and there's not a lot of options out there. So, yeah. Thank you, everybody. Thanks for the opportunity to come out here today.